So yeah, thanks again, Tom. Always a pleasure to be on the show. Especially excited today to have Phil here. So it's nice when we can get on here and talk about YCharts a little bit on our own. But having Phil here to tell his story and share a little bit about how he uses YCharts to really help out his clients is exciting to me. Again, I head up product management at YCharts. I'm here with Phil. I'll advance this slide a little bit. Phil's been a client of YCharts for several years. He's somebody we refer to internally as a power user. Really getting a lot out of our software. Probably could lean on him for some tips ourselves, because he uses it so well. But Phil's been in the industry for a while. Aside from what he does on the investment side, I'll say too, we always appreciate the content you put out, Phil, and it's always very insightful. So, that's kind of a quick introduction on you, but I was hoping you could take over here and just share a little bit more information about Savant and your role there.
Sure. So we merged. Our predecessor firm was Huber Financial Advisors, and we had been in business for a little over 30 years, based in Lincolnshire, Illinois, and Chicago, Illinois. We were around $1.5 billion pre-merger, a little under 30 employees, and so we spent the bulk of 2019 getting to know Savant and coming to the conclusion that they would be a great partnership for us to come together and join forces. And so our timing was quite fortuitous and lucky in that we closed our deal in mid-February and were able to get that done before things got quite crazy as they have lately. So it's been a real joy to be a part of this larger team, and we're excited about what the future holds for the combined organization.
Well, good, yeah, and congratulations again on the big move this year.
Thank you.
Jump into the next slide here. So only take a minute here, but did want to give just a little bit of background on YCharts for anybody tuning in today that isn't super familiar with our software. So YCharts combines expansive data and tools, and we do that in a way to hopefully help our clients make smarter investment decisions and better communicate those insights also to the market. So how do we do that? We kind of aim to support this entire investment process. So, depending on where you start, might change based on kind of what you're coming to us initially for. But whether that's idea generation, analysis and due diligence, really digging deep on new ideas, portfolio construction, really monitoring your positions in the markets, or going through that evaluation of strategies and making changes. And we have tools and data that you can see on the left here that kind of support every step of this process. But then I think another important piece of what we offer are the different visuals and components that you can take out of YCharts as you go through this process. So as we go through this use case, there are actually a couple of use cases today that Phil's going to highlight. Hopefully some of this stands out not only as the work and the analysis that you can do within YCharts, but also some of the pieces and charts and visuals that you can take out of YCharts to share with your network, to share with your clients, to share with your colleagues, to help take the effort that you've made to develop these insights and make them more communicated to other people that you're working with. But without any kind of further ado, I do want to kick off kind of these three use cases that we're going to talk through today. We're going to look at a couple examples. The first one's going to be the rear view mirror, and we'll explain more about what that means in just a second. The second one is going to be an example taking a client or a prospect that's an executive at a publicly traded pharmaceutical company. We've got the Abbott logo here. No actual ties to Abbott here. This is just a company we're going to use for the example. And then the third example is going to be someone who's kind of sitting on too much cash. So let's go ahead and jump into the first example here. All right. So Phil, first example here, we're looking at a client who's had some good luck in the past by holding a few concentrated stock positions. I'd love to hear, your take here on, excuse me, some of the challenges and opportunities that you have when you're working with a client kind of in this situation.
Sure. Yeah. So I mean, we have these names up on the slide here, but these are just hypothetical examples. But I think all the advisors on the call today have probably had this type of scenario where a new prospect or client comes to you and they just have a handful of concentrated positions, and in some cases they're given that we've had these really extreme winners over the past decade, positions with very large embedded gains that have served these clients quite well. And so not only is there a component of kind of letting go that they're hesitant to do so from a tax standpoint because you have very low cost basis in many cases, but also potentially an emotional connection where they just feel these connections to these companies or these stocks, maybe because they use the products every day, or just because they've made them wealthy beyond what they possibly could have comprehended. And so that's a great thing that they've had these outsized gains, and that has built up their nest egg. But if you get too concentrated and too tied to individual companies, we've seen this many times throughout history, that any one individual company, even though it might seem like there's no chance of them being dethroned, or that there's nothing that could possibly happen that could take them off of their pedestal. I think history is just littered with too many examples that would point to the opposite of that. And so we think that can end up what served people well can end up being their biggest risk. And you would just hate to see a client who has benefited tremendously have the opposite effect take hold, because they were too hesitant to take chips off the table and move into a more diversified posture. There's always that saying, concentrate to get rich and diversify to stay rich. And so but you also want to do so responsibly from a tax standpoint, et cetera. So that's just kind of setting the table, I guess. If you want to move to the next slide, we can kind of walk through different ways that you can kind of demonstrate that concentrated risk to a prospect or client, and ways to present proposals and a way forward from there.
Yeah, definitely. And we'll move into that next slide. I really liked what you said, concentrate to get rich, diversify to stay rich. I think it's a great concept. Probably everybody on the webinar today understands that concept, but how do you explain that to a client that is feeling really good about that concentrated portfolio that they're in?
Yeah, it can be a real challenge, and the whole concentrate to get rich, it doesn't have to be from stock picking. A lot of people, have accumulated wealth from betting on themselves in their own careers or businesses, and concentrating their risk exposure there. But I think what you want to show people is it's easy to look back in hindsight and see like a 10-year total return number, and maybe look at that with rose-colored glasses, and maybe forget that it wasn't necessarily a straight line to get there. And that many of these big winning stocks over time have had some pretty gut-wrenching drawdowns and volatility. And so, kudos to them for sticking with that if they've held it for so long. But it can be easy to forget that those gains weren't necessarily a free lunch. And so I think, depending on where somebody is in their life cycle as an investor, be it accumulating stage or getting close to retirement or decumulation, particularly in that latter scenario. Being overexposed to just stocks in general and a specific sector or style or handful of companies, those are the risks that can derail a financial plan when you start to live off of your portfolio for income. And so I think, really putting together some comparisons to risk and return and volatility for someone who really needs to de-risk their portfolio over time. And I think too, extending, the nice thing about YCharts is just the rich history of data and indexes and funds that extend well beyond just the last 10 to 12 years, which was, predominantly up until this year, a bull market period. I think, going back to the crisis and then even the early 2000s can give a lengthier history to show that, this wasn't always the case, that other styles have come in and out of vogue, and that these things tend to be cyclical, whether it's US versus non-US stock performance, value versus growth, large cap versus small cap. And so YCharts has a lot of ways in which you can kind of highlight and illustrate that to clients.
Yeah, and I couldn't agree more. One of the things you mentioned is drawdown here, and as I click here, this switches over to another chart, and this is a visual that you told me, is pretty impactful for you. So, I guess two questions. One is, how important are these visuals when you're actually sitting down with a client to explain why you might want to move into that more diversified portfolio? And I guess second question is, what are some of your favorite things to like actually show?
This is right up there. I think this tells a really good story, and it's just eye-popping, and I think it makes a powerful statement to a client that, wow, like, in this case, Netflix wasn't just this, straight line up. Like, you had to have the stomach and the wherewithal to really stick with it, and so I think it kind of says it all right there. So this is definitely something that the drawdown chart is something we utilize quite a bit.
Great. And then stepping into the next slide here, you mentioned diversification, and here we can see kind of snippets from some of the reports, that you might generate from YCharts that show many different kind of points of that diversification process and different ways that you might evaluate the two portfolios, one the very concentrated one, and one the more diversified one that you're trying to move into. I guess my questions would be, what are some of the things that you focus on in the discussion to really talk about diversification? What are some of the specific aspects of diversification that you look at, and to what extent do you share those with your clients?
Yeah, I think, as advisors, sometimes maybe we forget that, the end clients that we work with aren't, CFAs and don't have a ton of background in investing. And so what their perception or concept of diversification is might vary completely differently from how we as, investment professionals would view that. They might look at a portfolio of 10 to 20 stocks and just say that's all the, I'm spreading my eggs across many baskets, even if all those are big, large companies in the tech sector, for example. And so just having a number of line items doesn't necessarily make you diversified. And so I think having access to these different charts by market capitalization, sector, overall asset allocation, et cetera, can kind of show different ways to, demonstrate to a client this is what proper diversification looks like, not just how many line items you have on a holding statement, but rather the different areas of the market and different asset classes that you're exposed to.
Yeah, and we didn't share any of your super secret formulas here, but you do, if I'm not mistaken, have some kind of custom proposals that you use. You mind touching just a little bit on how those work and how you get those ready to meet with a client?
Yeah, so I guess maybe just to backpedal a little bit, you mentioned earlier at the beginning that I had been a user of YCharts for a while, and so there was a couple of years where I was just using the basic kind of basic level YChart subscription. And then we decided as a firm, we were using a competitor product to do our investment proposals, but given their kind of prohibitive license cost that they had, really we just couldn't, as we were growing as a firm and we needed more and more people within the firm having access to tools and running proposals for advisors, just having one license across the firm was creating bottlenecks. And so being able to expand our usage of YCharts and add more seats within the firm allowed us to spread those responsibilities around to a number of different people, and then also essentially create our own customized investment proposal report using the Excel add-in functionality. And so we spent a good deal of time as a team, and you guys were really great from a support standpoint in helping us design and build that out. So essentially we had the ability now to meet with a prospect, get access to their holdings and current portfolios, and having all of our model portfolios as well kind of embedded in that system, to be able to fairly quickly and easily generate these proposals in a short period of time to aid our advisors in those discussions, and just show our portfolio and what we're recommending relative to what they're currently doing in a number of different scenarios and metrics.
Good. And it seems, based on the success of your firm, that process has been working well. So let's recap this kind of first use case really quickly. We started off with a client that had a very concentrated stock position, or I guess a stock portfolio with a few concentrated positions that had performed really well in the past. So talk us through some of the main benefits that you would have kind of to talk through with a client, or some of the results that you might see in this scenario.
Yeah, I think in this type of scenario, you would, again, because we're leading with planning. The portfolio itself is just a vehicle to help the client achieve the plan. And so I think part of our discovery process with new clients and the way we go about starting with the plan and then using that to kind of back into the portfolio, I think can kind of show people, okay, well, I've sort of won the game with where we are today. We've had some really good gains. Here's what we want to achieve in our lives. Here's the type of return profile that we need to get there, and how much risk we can take to do so. And I think it can be illuminating for people to see, wow, we can really take a lot of chips off the table, de-risk, and still do everything that we want to do as it relates to retirement and college planning and all these other items that people want to check off of their financial goals list.
Sure. Great. All right, so let's jump into the second use case here that we were going to profile. In this case, a little bit different, right? So you've got a client who has a pretty concentrated position, but that's due to a long career at a publicly traded company. So again, if you could tell us just some of the challenges and opportunities that you see in this scenario.
Yeah, so I guess maybe on the client side, this is a bit of a different concentrated stock scenario because it's tied to the client's employer. So even more so, I think, in these situations, and I think everyone listening in today that's worked with clients that are working in publicly traded companies, there tends to be a lot of perhaps overconfidence in those positions, and maybe limited ability to see any downside scenarios in that stock. So that's one factor. And then I think a number of advisors tend to not just have one client that works at these companies, but rather a potentially a roster full of them. If they're cultivating some sort of niche within a particular, maybe it's a company that's local to their geography that they've, gained a few clients in, or maybe it's a certain industry or sector that they kind of specialize in from a planning standpoint. And so I think that it makes, when you have clients that have a great portion of their wealth tied to their employer stock, it's effectively kind of doubling up your human capital and your financial capital. But you also, as an advisor, you have an obligation to be able to stay on top of those companies and what's happening, both for the stock itself, any news that's out there. So I think having a tool like YCharts to be able to create alerts, have different reports that can be generated on a call it daily, weekly, monthly basis that keep you updated on your clients' positions. Could be fundamental metrics. Maybe you want to monitor the stock price for certain levels or price movements, or various technical indicators, just so you can be alerted when there might be something you want to reach out to the client about before they reach out to you about it, because that's you want to show that you're being proactive and on top of things, not reactive and only pulling it up when they call and they're on the other line. So this to us has been another way to do such a thing.
Great. And I think, just touching on the visual here, in this scenario, we kind of picked Abbott as an example. Abbott, a stock that has actually done really well in bear markets, especially done well over the last few months. But, in this case, we were able to, in YCharts, and I'll point to the branding here too on your chart, where you've got your colors and your logos, but being able to show, hey, during the last big recovery after, that bear market, Abbott tended to underperform a little bit. So as you look to move into that more diversified position, I think a chart like this can be pretty valuable.
I know we have new colors coming too. I wish it was a few weeks from now. We've got new branding, and I think the new color scheme is going to be a lot prettier. So unfortunately,
well, the good news is
I couldn't unveil that today, but
just send those colors over. We'll get you updated.
There you go.
And you talked about this a little bit too. You talked about the alerts, but I have to imagine that when you're moving a client systematically out of a concentrated position and into some other holdings, the timing matters a little bit. So what are some things you keep an eye on for the timing of those moves?
Yeah, the timing's always going to be important with any one given name, and none of us have a crystal ball in terms of performance or whatever. But I think the nice part with alerts is this can be a collaborative effort with the client. It doesn't have to just be you, the advisor, picking a bunch of random price levels or things like that. It could just this could be a sit down conversation. And the beauty of YCharts is it doesn't matter where you are. You could be at a coffee shop or remotely via Zoom with a client these days, and pull up YCharts and say, okay, like let's figure this out together, and it kind of brings them into the process. You can figure out what's more important to them. Is it the downside? Is it missing upside? And you can kind of tease some of those things out, and those can be informative into kind of what you want to screen for and be alerted to as it relates to the stock. And then as you can see on the right there too, just from again, back to this idea, if you've got 10 clients that work for the same company, being able to not just keep an eye on that company itself, but also competitors within the industry, the sector as a whole, all of that can be created in a customized email report that you can set up to, and that's an example on the right side of this slide here, is have that be sent out to you as frequently or infrequently as you'd like. So I think those two pair well together, the alerts and the reporting feature.
Yeah, well said. And then I think something that you mentioned when we were talking the other day, Phil, that I thought was really interesting was, and you kind of alluded to it there again when you talked about sitting down with your client, maybe at a coffee shop and talking through this, but having a plan, right? And then that way you have like a rules-based plan to move from a position out of that into that more diversified portfolio. So what are some components of that plan that you've seen work pretty well?
Yeah, I mean, the having just a plan in general is of utmost importance, because it can help, sometimes not entirely, but it can definitely help remove the emotions from the equation, which again, when it's someone's employer and they've spent their career at this company, that can be a really heavy component. So again, there's no one right answer, but maybe if we just want to use, maybe it's the stock hits a certain PE level, and that can kind of prompt you to sell a certain amount, or maybe it's if it crosses below a certain technical threshold, like a 200 or 50-day moving average type scenario. So maybe the trend can be your friend. It cannot be. There's more than one way to skin the cat, I guess here. But I think maybe some combination of those. Those can all be easy ways to stay on top of things and find a way to document and say, okay, well, here to the client, this is what we're going to do. This is when we're going to do it. This is what's going to trigger it. Make sure you get that all out in front of them, and so they've got it saved somewhere so that it's not a surprise to them when you reach out and say, hey, here we are, what we laid out, what would potentially happen, it's happened. I think it's time to move and trim some of this position. And just having that conversation, that prior conversation there, will reinforce, okay, this is part of the plan. This is not just us kind of sticking our finger in the wind and making some kind of educated guess. We're trying to really be thoughtful about this.
Yeah, I like that. And then our next slide here shows, kind of the gradual movement away from that concentrated position. So what we did here is we took a portfolio and we combined it with a position of Abbott stock and made kind of 4 different portfolios. The first with 40% of Abbott, then we moved that to 30, 20, 10. And I think there's some interesting things you can see as you combine that position with the rest of the portfolio, as far as just moving out of this concentrated position and what it does to diversify your overall portfolio. I know you've already talked this a lot kind of over the last couple slides, but anything additional that you'd add here, just as far as the nature of the risk or exposures, as you kind of make the shift?
Yeah, I mean, I think it's just telling, as you see there, as you reduce that exposure, you're taking down that sector exposure to a more reasonable level. But I think what I like about this slide is kind of showing these are with anything with clients, usually it's like not baby steps necessarily, but doing things in kind of a stagger step way as opposed to kind of all at once is much more palatable usually to their experience. Instead of taking it from 40% immediately to 10, having a few steps in between. And this, you could say the same thing for like a major allocation change. Maybe someone wants to, de-risk, from their 80-20 portfolio to a 50-50 in retirement, but they probably don't want to do that all at once. They want to do that in kind of segments over time. Same thing when clients have a lump sum, which we'll be getting to here in the next example of a kind of lump sum and whether to put that all in at once. All the data in the world tells us that's usually the right way to do it. Market tends to go up more than it does not. Trying to get a client to put that entire lump sum into the portfolio immediately tends to be a losing argument. That more often than not, they're just more comfortable behaviorally spreading it in over various increments and avoiding that sort of maximum regret of putting it all in potentially at the wrong time.
Yeah, certainly. So let's move into that. Before we do, I guess just quickly, kind of recapping the results here. So we started off with a client that had accumulated a decent amount of stock at the same company they worked for. And I guess the end result is you shifted them into a more diversified portfolio that's kind of better suited for achieving their plan, right? I think that was the big point.
Right. And I think the big thing here is to demonstrate your value as the advisor by showing that you have a vested interest in what's happening at their company and that you're on top of it, and they understand that things aren't going to get by you. And the beauty here is you don't have to set calendar reminders for yourself to go poke around the internet and figure out what's going on with in this case Abbott. You can automate and streamline all of that so that it comes to you as opposed to you having to go remind yourself, potentially forget about doing it, and just kind of be scattered all over the place looking for different data points. You can kind of get it all sent to you in one nice neat package.
Great. All right, so moving into our last kind of use case here. And in this case, we've got the classic situation of someone just sitting on far too much cash and a little hesitant to part with it. So how do you?
Yeah, I mean this is a common experience for many advisors having and there's nothing wrong with having extra cash by any means, and obviously we would always encourage clients to keep as much cash to support lifestyle expenses or having an emergency type of reserve, or even just enough to feel comfortable depending on how volatile their career prospects might be. And so there's many reasons to hold cash, but at a certain point it can be detrimental. And I think cash obviously can serve as kind of a security blanket for people. in periods of volatility. And then there's always, of course, people refer to, I'm keeping it as dry powder. Everyone thinks they're going to be the next Warren Buffett when the market goes down 30, 40%. And then when it actually happens, it's like, I think it's going to get worse from now. I'm just going to stick with my cash. So as much as people want to think that they're going to just plow that in and put it to work when crisis arrives, they almost tend to cling to it even more, at least from our experience. And so, and again, cash feels safe. It feels like you're not taking risk. But there's risk everywhere. Effectively, you're just trading one risk for another by, if you're just holding too much in cash, that might be limiting your overall long-term portfolio returns and potentially to a level that is just not sufficient enough to meet your long-term needs. And so obviously that goes into the planning process, but I think finding a way to encourage clients to use periods like we're in now as opportunities to kind of leg in and put some of that to work. But not, again, back to the point earlier, not just making it a sort of guessing game or letting them sort of drive when they want to do it, because it's usually potentially going to be at the wrong time. And so there's ways we mentioned earlier, using alerts and other watch lists and things like that you could say, okay, like let's develop a plan together, back to that collaborative approach with the client, and figure out, okay, what's our portfolio target look like? What are the positions and asset classes that we want to get into? But then also, how can we figure out, again, not very precisely, but in a way that is measured, and say, okay, like what, let's use, maybe in emerging markets as an example. We want to track, there's the broad emerging market index, and if it, reaches certain levels from a trend standpoint, from a valuation standpoint, or some combination thereof, and maybe that's our opportunity to get in there. And you can, rinse and repeat with, the different parts of the portfolio that you're wanting to get into. And then the beauty being just, you can kind of have that all sort of saved, easy to pull up again, in different terms, terms of screeners and watch lists. Those are all, living and breathing on the system itself, and can be retrieved pretty quickly. And you can even, if it's specific to one client, you can save it for that client, so that when they call up, next time, we can quickly pull it back up and say, here's what we're trying to buy over time. Here's what we might want to use as potential metrics to follow in terms of kind of when and how we want to get there.
Yeah, and I really liked, you mentioned a few times having that kind of systematic plan, but then in this scenario, you talked about being opportunistic also. I have to imagine there's a certain level of value when you reach out to a client and you say, hey, remember how we were keeping an eye on some of these positions? We actually think it's a opportune time now to move into these few positions because we've been doing our research. Do you get great feedback when you have those conversations? Are people usually
Sure, especially if the trade works in your favor and it actually
right.
ends up being a good timing entry point? And that's not always the case, but yeah, and I think back to, I know this isn't necessarily directly tied to this case study, but I think just having the ability to, like, because we create charts all the time just on the fly, depending on what we might want to look at, either individually or with a client. But there's always like those go-tos, and I think that's important for the advisors. If you've got a certain set of fundamental charts that you just know that you end up using in every client conversation, you can build a library of those, and it takes just seconds to pull those up. So I think just kind of reinforcing that this is such an effective tool for those, spur of the moment conversations where something might come up, and you can just have the browser up, logged on the screen, and be able to retrieve it pretty quickly.
Great. So perfect. So, again, kind of wrapping up the last use case here. We started off with a client that was holding on to, probably more cash than they needed. You mentioned, having some cash is certainly important and part of the plan, but, moving them out of that cash. And then, if you wanted to summarize some of the benefits of where they ended up after this process, I think that'd be helpful.
Yeah, I mean, I think, showing like that first slide you had in this section of just that long-term, almost Ibbotson looking chart of, T-bills, bonds, I think you had gold, large, large cap, small cap. So kind of that stocks for the long run, show, hey, like cash might feel secure, but, relative to your purchasing power and net of inflation, in some cases you might be losing money. Here's what you get long-term by being invested in riskier asset classes. It's not always fun, and there will be, periods of drawdowns, but just giving them that long-term perspective on here's why you want to get that cash invested, because you need those types of returns to support your retirement. So I think getting them just on board that and in agreement that yes, we are sitting on too much cash. We've been waiting for a pullback forever and it hasn't come, and now we feel like we've missed out on all these gains. And so you want to have them be at least prepared. Okay, like, you say you've been waiting for the moment, and now in this case, we are kind of in the moment. Obviously, it's come back a bit, but just, having them say, okay, like when the time comes, you want to be ready to be opportunistic, like you mentioned earlier. Um, still maybe kind of stagger it over multiple rounds, not feel like someone's got to go from this all or nothing position. But again, back to, we've just said this several times throughout the conversation, but having that plan in place to get to the ultimate place you want to be. And I think YCharts, helps you establish, rules-based plans and guidelines to do so.
Perfect. So just summing everything up here, we kind of went through these 3 different use cases. I think some of my big takeaways, and I certainly don't want to put any words in your mouth, but correct me if I'm wrong on any of these. First of all, that initial conversation or kind of outlining that plan with your client is hugely important. And I think being able to take some visuals and some kind of factual but easy to digest information into that conversation with the client, goes a long way. The next step is being able to track that plan that you put in place, right? So whether that means setting alerts, keeping an eye on data, having visuals that either hit your inbox you can easily access to make sure that you're staying on track with that plan is an important way. And then kind of communicating what you've accomplished throughout that process with your client. And then lastly, kind of as you move to that point of arrival, being able to keep an eye on that overall portfolio and allocation and continue to make moves, even though you've already substantiated the kind of big move that you want to make for that client. I'm sure the work's not done at that point. So just maintaining those positions as well.
Absolutely, and like you said right in the beginning here, visualization is key. I think clients are just by nature just very visual. When you throw a spreadsheet with a bunch of numbers in front of them, it can be daunting and it can be kind of deer in headlights at times, because it can just be overwhelming if they're not accustomed to seeing things like that and they're not familiar with a lot of the terminology. But everybody responds to visuals better, and I think for RAs, the nice thing is being able to slap your logo on the bottom of these charts, being able to customize the color scheme to meet your branding can just help connect those visuals and images and charts back to you as your firm.
Yeah, that's great. And I will say, Phil, thank you for all the insights. It makes my job a lot easier when we get great feedback from clients like you. I always encourage our clients to share with us things they want, but I love the success stories and hearing how well things are working out in the field. So certainly want to say.
And the nice thing is, we've had our handful of users from the Huber side before the merger, and then we now have one of the analysts at Savant logged in on the YCharts, and the feedback I've gotten is he's using it a ton already, and he's only had access for a few weeks now.
That's awesome. That's great to hear. All right, so I did want to save some time for questions. If you do want to get in touch with us, ignore those underlines. Those are all spelled correctly, even though Google seems to think they aren't. But Tom, if you're still on the line, I'd be happy to, I imagine more questions for Phil, but field whatever we can in the time that remains.
Great. Well, thanks, guys. Appreciate it. And folks, again, if you have questions, feel free to post in the question panel. I failed to announce that I will show the dashboard for members, just a refresher on that. For those of you not comfortable with logging into the site, tracking your webinar attendance, CE credits, etc., feel free to stick around. We will dive into that in a matter of a few minutes. I am also going to fire up a poll question. If you're interested in learning more about YCharts and chatting with one of their reps, I encourage you. And by the way, the best way to answer that polling question is to minimize that box. And I've learned in just the last week that it's problematic if you don't. So again, to make sure you can respond to the polling question, if you want to minimize your screen, I've been told that's the workaround. So again, welcome any questions. I'm going to just leave this up for 20 seconds or so, and certainly encourage you to learn more about the program. And I think it's and I welcome your feedback. For those of you listening on the format today, as you know, we've had my goal is to have these case study centric sessions, and certainly as a kind of a second webinar series track in addition to the weekly sessions we have on what I call big topics. So I certainly welcome your feedback here, and the whole intent is to narrow the focus, and give you the opportunity to ask questions and interact with our guest speakers and experts. So, all right, great. Well, thanks to those that participated, and let me, I think we closed that down. Let me make sure we did. I think so. Great. So give me 1 second to go to questions here. So what, I guess in terms of the typical client that you have coming in from Will, Caleb, what does a typical client profile look like for YCharts?
Yeah, it varies. I think, looking at just Phil's progression kind of shows that story, right? So we have a lot of clients that might be at smaller firms, kind of in that range of 100 to a couple $100 million under management. But then as you get to know our software more, and we're certainly able to support the use cases once you're at that several billion-dollar firm range. So I think also the point that we've talked about several times today, that communication point, regardless of how you're operating your assets, how you build your portfolios, it's still important to be talking to your clients about the reasons that you've put them in the investments that you have. And what YCharts brings to the table with a lot of these visuals and really helping you to build those around your brand, I think that opens up our use cases to pretty much anybody in the field. So I guess a vague answer, but hopefully helpful.
Yeah, maybe just to piggyback on that, I think one of the new, I guess it's not that new anymore, but relatively newish features on YCharts is that model portfolios functionality, and I think that is potentially a game changer for a lot of RAs that build and manage portfolios, using models, to just be able to kind of build those and centralize those in a place like YCharts, but then also be able to quickly just keep tabs on your dashboard in terms of kind of performance of each model, different underlying stats of each model, and then being able to run kind of proposals and reports on all those, or fundamental charts or anything like that relative to benchmarks. So that was, I think, one of the best additions that they've had in the past couple of years to the platform, and looking forward to kind of seeing that feature be just kind of built upon and expanded over time.
Yeah, I'd be curious for those listening. We have a question coming in here. Are you? I know many of you listening are, I think, are I'll call it solo practitioners. Are you this deep into, I'll call it, investment portfolio management? So again, for everyone listening, if you want to just kind of shed some light on kind of what your practices are around investment management, that would be great. Here's a question from Robert. So for someone trying to accumulate, well, say I have a friend who is young, looking to get into the market, how far would you take the concentrated to get rich, diversified to stay rich saying, and thinking about building a reputation with people who could in the future become clients? So Phil, I'll bounce that over to you. And again, that's from Robert.
Sure. So I guess if I'm putting my CIO hat on in terms of how we manage our portfolios, that we're not in the concentrate to get rich business in terms of what we're investing in and the types of portfolios that we're managing. We're much more diversified, even for all kind of equity investors. We use combinations of mutual funds and ETFs, and getting really broad-based, low-cost exposure. And so we're not stock pickers ourselves. But I think back to the point, there are a number of professionals, young professionals that are in that accumulation stage, and maybe have been doing some of this on their own and have done quite well in their own investing adventures of stock picking or what have you. And so I think there is opportunity to educate people that you come across that have gotten that, and then use tools like this to say, okay, like this has been successful, and maybe you want to keep doing stock picking. Maybe it's entertaining. You just have a passion or a hobby for it, but you don't want to be that can't be the sole focus of your investing. You want to have a different bucket that's more long-term, less speculative, that can rely a little bit more on evidence, and more of an evidence-based approach to long-term wealth growth.
Okay, great.
Hopefully
so
that answers the question.
I think so, but Robert, if not, feel free to ping back. I'm just curious, in the second scenario, where was the one that involved the Abbott Labs and the high concentration, and then trying to stagger them to reduce that position. when you do so, do you have metrics around like what the impact would be, for example, on the standard deviation of those proposed portfolios or that migration path? Do you have other metrics that come along with what you all provide?
Yeah, I think we can show the kind of pre and post portfolio levels of risk, and then standard deviations one. I think what we had up earlier on drawdown risk as well is, I think to me I like that better than standard deviation. Standard deviation is a number. It's hard to for non-finance people to really get a feel of what that means or what's considered high or low. But when you show someone from all-time highs something that went down 70-80%, and that's just a much more a visual way to say, oh, okay, that looks to be more risky than this other portfolio that you're showing me. So yeah, there's all the standard risk metrics, but also good visual ways to show that as well.
Okay, great, thank you. Okay, I'll just put one last call out for questions. Certainly grateful for both of you taking the time and putting the effort that you did into the slides. Certainly would love to have you back, especially as the market goes up and it goes down and moves all around. And certainly would welcome, welcome having you back and sharing your insights in terms of what your experience is, especially with the client side of it. To me, that's another interesting element. So. So again, I think that's it for now, and I'm sorry, but I want to try to take a little time to show folks the dashboard. But Phil and Caleb and Will, who's listening in, thank you so much. You're welcome to stay on and watch our exciting tour through the back end of the website if you want. But thank you again. Thanks both of you.
Yeah,
appreciate it.
Love to come back at some point, Tom. Thanks for having me today, and thanks to Caleb as well for moderating.
Yeah, of course. Thanks, Phil. Thanks, Tom. Everybody stay safe out there. Appreciate it.